Hey everybody, it's your boy Sean McLaughlin at Options Sean on Twitter X. Today is Tuesday, September 2nd, 2025. Summer is over. Wah wah. All right, I know technically summer isn't over, but when Labor Day comes, to me, that's the end of summer. And I had a great weekend. I hope you guys had a great weekend too. My Chicago Cubs, I'm a Chicago Cubs fan. They came to town and played in Denver. I took my son to the game. We had a great time. We had a family wiffle ball tournament this weekend. Man, and spent a lot of time outside. So great weekend. Hope you guys are doing well. So this is the What Are My Options show. What are my options? This is a show where there's no script, there's no plan. It's basically me holding office hours for you to ask questions about anything options related, and I'll do my best to answer it as best I can to my ability. I don't know everything. I know a little bit. I've been doing this for 26 years, but I certainly don't know everything. But this is a chance to ask questions. We could talk about positions and all-star options if you have them. If you have a trade you're thinking about putting on and you need a little guidance as far as what option strategy to use or things like that. This is a great place to ask them. Dan, I see you in the chat. What's up, Dan? I hung out with Dan yesterday here in Colorado. Great day we had yesterday. All right, so we're gonna start off with a couple things. We're gonna start off with I have two things that I do want to talk about. This isn't scripted, but these are on my mind. So first up, Izzy, if you want to bring up my chart here, I got ticker here, Viva Systems, ticker VEEV. This is a trade that we had on an All-Star Options. We got into the trade back in mid-May. It was a September bull call spreads were long the September 250 calls and short the 300s. This trade started out, I mean, the first few days we got into it, it was kind of going against us, which was no fun, but we held in. And a big reason why we got into the trade, or the big reason why I liked the trade is I thought that earnings were going to be a catalyst for us. And sure enough, earnings were a catalyst. This big gap that we had here on May 29th was a reaction to their latest earnings report, and it gapped higher. And that's great. And it was in the profit zone for us, but then the stock just kind of chopped sideways very frustratingly so for the next 3 months or next 2 months. And so now here we were. Today's September 2nd. We're into the expiration month for these options. And guys, the best practice I have with options is with my swing trade option positions is that once I get into the expiration month, so once the calendar flips to the month of expiration, in this case, these were September options, right? Then I start really tightening up my stop because I don't want to either A, give back hard-earned profits, or B, if I'm sitting in a position that, maybe I'm up a little, maybe I'm down a little, but the options are kind of close to the money, right? They're kind of right around the strike prices of my options. At that point, theta becomes an enemy as we start getting closer and closer to expiration. As we get closer to the expiration day, the value of those options are going to start losing premium more and more rapidly. So when the calendar turns into the expiration month, that's when I tighten up my stops and need to get out. But here with Vive, we had two things. We had two signals to get us out of this trade. Number one, you can see this 270 level here on the chart. This was the level that it was kind of like the bottom end of the range. I didn't want to see Vive break out of that range, right? If it broke below that range, to me, that was incredibly bullish or incredibly bearish, excuse me. And we got that this week or on Friday, we closed below that 270 level. That's my signal, right? I'm waiting for a close below the price. I don't exit intraday typically. I wait for the next day. So already all by itself, we got the exit signal on Friday, and today when we opened, we were still below that level. So that a reason alone was a reason to exit. But even if this close yesterday or on Friday wasn't below that 270 level, right? Even if it wasn't below that level, it was certainly a 3 to 5 day low closing price. And so when I'm in the expiration month and I'm tightening my stop, I trail my stop using a 3 to 5 day low. I use a little discretion, right? There's no magic to this, but I don't want to see a position go against me breaking a 3 to 5 day low. So in this case, Vive caught me on both things, right? It broke my long-standing my stop level of 270, but also it was making 3 to 5 day lows, right? So I don't want that. Not in expiration month. So it's time to cut and run. The good news here is that I paid 12.75 for this spread back when in May when I got into it. And even though it feels like a loss because the position's been moving against me, I ended up closing the spread out for 19.85. So I paid 12.75, got out for 19.85. That's about what? That's a $7 profit on a $12 investment. What's that math? 65%ish? Not a bad return. Not the return I was hoping for. I was really hoping you see this 300 level up here. I was hoping to take profits if and when Vive got to 300, and it looked close. We had a couple of close calls on that one. Never quite got there. That was a bummer. But hey, first class problem. We're exiting with a profit. Nothing to be upset about. Good trade. If you join me on that one, great. By the way, guys, as I'm rambling here, I see some of you put in some comments in the chat. That's great. If you have any questions, just put them in the chat, and I will get to them as well. Jackson says, "Would you take the first 3 weeks of September off just for seasonality and manage current positions as a general rule?" Jackson, taking 3 weeks off in September, that sounds glorious. I would love a 3 week vacation. I don't know if I can get away with a 3 week vacation. I've talked about this on podcasts and other places that I'm very bad at taking vacations. I could take short, little long weekends, that kind of thing, but it's so hard at taking vacations. It's the trader in me. It's, I need to be connected to the markets in some way or another. 3 weeks sounds, whoo, that sounds hard. I could not do that, Jackson. And look, if seasonality, I mean, if you're worried about seasonality in September, if you're worried about stocks going down, well, hey, there's strategies for that too, right? The nice thing about options is options give us options. I say this all the time. We can craft strategies to profit in any kind of trading environment, whether it's a bullish trading environment, a bearish trading environment, a neutral trading environment. Like let's say maybe the seasonality has you thinking that you don't want to be strongly bullish right now, but you're not necessarily bearish because we are in a bull market, right? Well, maybe that means we're setting up for some sideways chop. In that case, great. We could do things like sell iron condors, sell out of the money strangles. We could put on options bets that pay us for stocks to stay in a range. That's a great idea, right? We could totally do that. And that actually dovetails to one thing I wanted to talk about here. I'm going to bring up UNH. I was on Yahoo Finance last week. I was in New York City, and the fine people at Yahoo invited me to come into the studio and give a little talk, do something a little educational. And I don't know if you guys saw it. And I'm going to rehash a little bit of what I talked about there, and I'm going to use UNH as the example. UNH is one of those stocks that's just been beaten up, as we all know. It's been in the news for a variety of reasons. The stock has just taken a beating for the past year. But coming off this bottom here in mid-August, me and JC kind of put our heads together and we were talking about putting a trade on here. There were a number of reasons why we thought this might be a durable bottom. Are we right? I mean, it feels like we're right now, but we don't know, right? This thing could roll over again. I mean, this thing has been such a dog for such a long time. But I did something kind of uncharacteristic as an options trader is I bought stock in UNH. I bought it, I think it was right on this day, August 11th, I think is the day I bought it. My timing was pretty well, lucky timing, but sometimes it's better to be lucky than good. But I bought some stock in UNH. And my reasoning on that, and the reason I explained it to JC was that a stock like this that is a huge stock, a huge company, right? One of the biggest companies in the Dow, the biggest healthcare provider in the country. Great, that's a great story. I don't really care about that, but it's notable. Stock's been beaten up for so long, and it's not going away. The company's not going away. It seemed like a good opportunity to kind of buy it and hold it for a while. And with options, when you buy options, even if you buy leaps, you still have decay working against you. You need the stock to move. You need it to work within your time frame. But a stock like this has been so beaten up. I think it was down as much as like 60, 70% at one point off its highs. This is a stock I feel like you could buy it and just sit on it for a while. And the nice thing is it pays a dividend. Okay. Another thing we don't talk about a lot as an options trader, but this stock pays dividend. I think it pays like a 3% yield at the price I got in, right? So I bought the stock. I'm sitting on it. I have no pressure, no time pressure because I don't have any options that are expiring. It's a position that I hold now. But then I got the idea when I talked to the folks at Yahoo about, what can we do with UNH to help people improve their positions? I said, well, what about covered call strategy? right? What about if you own stock like I do? What about selling calls against it to increase your yield? And it could do two things. It could increase our yield while also reducing my cost basis. So if UNH rolls over again and goes down further, if I'm selling calls against it, doing a covered call strategy, I can at least, lower my break evens a little bit as the stock goes down. My break even level can go down with it, cushioning the blow of any losses. Now, selling covered calls is not a perfect hedge for a stock that's crashing, right? If a stock crashes, if it goes, rapidly down, the extra premium you collect from selling out of the money calls against that position is not really going to make that big of a difference. Yes, it's going to lessen your loss, but if a stock is crashing, you're going to get hurt either way. So I don't recommend covered calls as a hedging strategy, but what I do recommend it as is as a yield enhancement strategy. So what I proposed to the folks at Yahoo is I said, hey, with UNH trading around 310 right now, let's I'm going to flip screens here. I'm going to bring up the options chain in UNH. Let's see here. Oh, that same thing happened, Gene. Or Izzy, let me bring that back. Okay. I learned a new trick to unfreeze my account or my screen. There it goes. All right, so let's look at the options chain in UNH. We only have 17 days until expiration in September, so I'm going to ignore those options. I'm going to look at October. Right? When I'm doing a covered call strategy, I generally want to sell options that have somewhere between 30 to 60 days expiration because that's where I can start getting the sweet spot of getting attractive premiums for the options and having them rapidly decay. All right. So let's open up the options chain in October. And with the stock trading around 311, okay, there's no perfect way to do this, guys, but my rule of thumb is when I'm doing covered call strategies is I would like to sell a call that would yield me approximately 1% of the value of the underlying stock. So with the stock at 311, I'm basically looking to collect at least $3 on a short call, right? $3 would be 1% of 300. All right. So if I look at the options chain and I'm looking at October, it looks like right around here, the October 370 calls, I could sell these. I mean, if I hit the bid, I can sell for 320. If I'm patient, of course, I can kind of work a bid in the middle or work an offer in the middle there, maybe get filled around 320, 325. Okay. And if I were to sell that call right now against 100 shares, so I should point out for those of you who don't know, an options contract represents ownership of 100 shares of stock. So if I owned 100 shares of UNH, I could sell one call contract against that. And what that means, if I sold these 370 calls, then I could, I own the stock, right? But if the stock were to rip, if UNH were to rip above 370, then I'm on the hook to sell my 100 shares. I'm on the hook to sell them for 370 bucks. That's the strike price. Now, if I bought them at 311 and I sell them at 370, I'm selling them for a profit, right? It's a first class problem. Let's say UNH rips to 500 bucks between now and October expiration, right? Unfortunately, I'm going to have to sell my stock at 370, not at 500 that they're trading in the market. So my upside is capped, right? Um, but that's a first class problem to have. If I bought them at 311, I could sell, and I'm forced to sell the stock at 370. That's what, 60 bucks. That's about a 20% gain, right? Plus, I keep the credit that I sold these calls for. If I sold these calls for 320, I keep that $3.20, right? Plus the $20 in appreciation. And guess what? If I did this today, there's a dividend payment coming up in September, mid-September. I'm going to collect that dividend payment as well. So I bought the stock, I made money on the capital appreciation of the stock. I kept the premium in the calls and I earned a dividend. Pretty nice, right? Again, this works if the stock stays stable or goes higher. If the stock crashes, selling covered calls is not the perfect hedge for that. But I just wanted to kind of throw that out there. We don't talk about covered calls a lot. And I'm happy to answer any questions about that. But yeah, it's a strategy that can be attractive for those of you who hold stock that you don't want to sell. Maybe you don't want to sell for a variety of reasons. Maybe you don't want to sell and take the tax hit because it's a big gain that you have in the thing, right? Or it's just a company you believe in long term, and you have a position and you don't want to lose that position. You don't want to, but you want to earn some extra income on it. Covered call strategy could be a good strategy for you. And look, if I'm long UNH and the stock does rip, I'm short the 370 calls and a stock does rip and it gets, gets close to 370 or threatens to get there. I could always roll the calls out, right? I could buy to close the October 370 calls and roll them out to November, I don't know, 400. Maybe you can do it for a credit, maybe you pay a little debit, but hey, your stock is ripping, you're making money on your stock, so it's not really that bad of a problem, right? But there's a lot of different ways to slice it. But covered call strategies, especially Jackson, to your question about taking September off because of seasonality. I mean, if you think we're in for some sideways chop and stocks are going to go sideways for a while, and you owned a bunch of stocks, maybe in your retirement account or any account really, um, maybe a covered call strategy will help you ride out that sloppy time, right? Maybe bring in a little extra income. I think it's a great strategy, and I know a lot of people that's all they do. They own stocks that they own for the long term, so, favorite household stocks that everybody knows. And they just every month, month after month, are selling calls against their positions. And if they ever get called away, it's a first class problems. You're still making money. But if they want to be a little bit more active management, they'll roll the calls and play a little defense. But I know a lot of people who do that and do that very well. So, all right. Who thought in what are my options we'd talk about covered calls and things like dividends? But they're out there. They're real. We should talk about them. All right, let me look at the chat here. I see Jackson mentioned a couple tickers here. I see Jay talked about Leaps and Pepsi and McDonald's. Um, let's look at some of these tickers. We'll start with yours, Jackson. You said FSV First Service Corp. You got some tickers here, Jackson. What are you thinking? Like, are you what type of strategies? FSV, TEL, and FOA. Well, let's talk about those first ones. FSV and TEL have almost exactly the same chart patterns. I mean, I love this gap. This was an earnings related gap right here. Gap, and we've held it. I mean, we're down a little bit today, but we're still in that range. I mean, this looks like a great setup, Jackson. I mean, if this thing got up above, let's say 202, I would be incredibly bullish on this setup. Volatility, look at the bottom of my screen right here. Look at the volatility, uh, basically making new lows for the year, pretty close. I mean, we had some lows here in early August, but volatility is really cheap right here. So that means options are cheap, right? So if I wanted a position in a stock like FSV, buying simple calls here would be, for me, would be the play because they're cheap. If we look into the options chain here, let's open them up. Let's see if they're liquid. First of all, oh, okay. Bad news. Bad news. These options are not very liquid. Let me just open up these chains here. So here's what I'm looking at. I mean, the obvious one here is look at the volume column here on these calls. NA, none available. There's been no volume traded in these things. Now, that's not necessarily a bad thing, right? If there's open interest, but then look at the next column, open interest. We have a whole bunch of zeros. Nobody's trading these calls or puts, really. And that's strike two. Three strikes, you're out in options, right? If there's no volume, intraday volume, that's strike one. If there's no open interest, that's strike two. Strike three would be bid ask spreads that are obnoxiously large. And look at this. I mean, the stock's trading at 197. So basically, the at the money calls in October are the October 200 strike. And look at this bid ask spread. We got a bid of 205 and an offer of 6. That is an enormous spread. That is a spread where you've got a market maker in there putting in a low ball bid and a low ball or high ball offer, hoping, begging for somebody to take his bid or take his offer. He will happily sell to you at 6 or happily buy from you at 205. Happily, happily. So unfortunately, SFV as an options trader is a no play for me. There's just no liquidity here. We can't trade this. Now, I will throw a little caveat in here for those of you who are adventurous. If this is a stock that you really believed in, and look, I mean, look at this chart. This is a chart I certainly believe in. But if it's a stock that you believe in, and it's a stock that you'd be willing to take ownership of, meaning you bought call. Let's say you bought the 200 calls, right? And the stock goes to 300 bucks, right? Great. Your options are worth a lot of money, but there's probably going to be no liquidity in those options. You're probably going to have to pay a lot of slippage to get out. at a, you're not going to get out at a fair price. You're going to give up two, three, $4, which is a lot of money, right? If you're willing to take ownership of the stock, if you're willing to exercise those calls on expiration day or at any time, really, when you own the calls, you can exercise them anytime you want. But if you're willing to exercise those calls and take on the stock, and you have enough buying power in your account to take on 100 shares of that stock, then by all means, maybe you do buy these calls. You're going to have to be patient to get your fill, and I would kind of work slowly. With the stock bid at, or with the options, these October options bid at 205. Maybe I'd put in an order to buy them at 210, and just keep upticking my bid a nickel at a time until hopefully I get someone to bite. Hopefully I can get filled around $3 on these things. But you have to have a strong feeling that this stock is going to go up, and you're willing to hold it, and you're willing to exercise those calls. That's really the only way I would consider getting into an options, a call option position in the stock. Certainly not doing a spread, right? Multi-legged option spread. Um, the more pieces to the puzzle that I have to put on, the more slippage I'm going to take put the trade on. So Jackson, I would buy if you said to me, Sean, I have to put this call trade on. Okay, buy the calls, do it slowly, work your bid. Certainly don't pay that offer. You don't want to pay $6. Forget that. Work a bid, and be prepared to exercise and take possession of that stock, and then sell the stock. Right? If it's not a position you want to hold long term, you exercise the stock, and you'll get a much fairer price selling your stock on the way out than you will selling the options. All right. So there's a little lesson for us. I didn't think we'd get there. Let's look at that TEL chart. I mean, similar chart, right? Similar story. Had a big earnings gap. We're trading sideways. Volatility's come in. It's very cheap. We could buy calls here. Calls, theoretically speaking, are going to be cheap. Let's see what the volatility or what the volume is. Okay, so these options look a lot better. Okay. Let's just look in October, just for argument's sake. Not that October is the best month to choose, but let's just look there. Now you'll notice, okay, strike one, right? There's only one contract in volume traded today. Not ideal, right? But in the open interest column, you see that we do have some open interest. There are people with positions in these calls. Okay. So that's a silver lining, right? There is interest here. There has been trading. But then finally, the last piece, right, the bid ask spread, were bid 390, offered 420. And again, these are like these slightly just out of the money calls, right? 30 cents, some of you might think that's a wide spread, and that is a wide spread, but this is a $4 contract, right? A 30-cent spread is not that unheard of. And I'd be willing to bet that if I were to put a bid in right now, splitting this difference, put a bid in to buy at 405, I'd be willing to bet I would get filled. And if I don't get filled instantly, if I just let it sit for a minute or two, I'd be willing to bet I would get filled. All right. So these are options I would trade. All right. I would trade them carefully. All right. I would take my time. I would work limit orders. Guys, never pay the offer when you're trying to buy calls or puts. And when you're trying to sell and get out, never hit the bid. Not if you can get filled midway. Always, I mean, at the very least, try to get filled at the mid price, right? Maybe you could try to cheat and get a little cheaper, right? Like on this 30-cent wide spread here, the mid price is 405, right? Maybe you put a bid in at 4 and just see. You might get filled. And then you got a little price improvement. That's great. Certainly, I think you'll get filled at 405. Definitely you get filled at 410, right? But don't pay the published prices. Don't hit the bid to get out. Don't take the offer to get in. The only options you could really do that in is like something like, I don't know, let's just bring up SPY, right? Super liquid options like the S&P 500. These bid ask spreads are like right here, 3 cents wide, right? Bidding 852, offered 854. You could take the offer on those, right? Because the spread's pretty tight. But in most cases with options, certainly never use a market order. Always use a limit order. Try to work a mid price somewhere in the middle. That's the best way to get filled at fair prices. The market makers are not your friends, right? They want you to hit their bids, and they want you to take their offers. That's how they make money, right? Because they have very sophisticated hedging techniques, and it's all computerized, right? If you hit their bid, they're going to immediately, faster than you could blink an eye, they're going to immediately hedge that with stock to cover their delta risk, and they're going to make their money off the bid ask spread. So don't do the market makers any favors. They already have an advantage. They don't need any more advantages. Okay. Jay was asking about Pepsi and McDonald's. Let's look up Pepsi and McDonald's. Well, Pepsi had a big gap today. It's giving it all back, or not all of it, but the stock opened up at 157, now trading at 152. Um, do I like it? I mean, if it didn't fade all day, I might like it, Jay. I'm not liking it right now. Let's see how the day ends on this one. Um, I think if it could get back above today's highs, right around 158, that's pretty bullish. I mean, if you go back in the chart here, that was 158 level acted as a little bit of resistance back in February and March. So if we can get back above 58, maybe this thing has some room to run. Um, but yeah, I don't like it here, Jay. Um, Not sure what you had in mind as far as an option strategy. You could see implied volatility is rising a bit, which is interesting. Did they have earnings today? Why the gap? Or were they? I don't pay attention to the news, guys. You know that. But it doesn't look like they had earnings today. But volatility is rising. The options market knows something. Somebody knows something. If you were to put a bullish bet on this one, Jay, I would probably look at a bull call spread to minimize the impact of paying for high volatility. Maybe even selling a put here. Selling a put might not be a bad idea. Let's look at the options chain here. Let's look at October options because that's between 30 to 60 days. Actually, let me bring the chart back up real quick. Let's look at like selling the 150 puts, right? And then we'll use 150 as our stop, right? If it gets below 150, we're out. But if we looked at the 150 puts, we can get 450 up 460 for these, right? Which is a 3%, a 3% yield based on the price of the stock, right? The stock's trading at 152. So if we got like 460, that's about roughly 3% of the value of the underlying. I actually kind of like this, Jay. Now I'm kind of talking myself into this. Maybe sell these 150 puts in October, get, 455, 460, right? And then what I would do if I had this position on, I would leave a resting order good till cancel to buy these puts back for half of what I sold them for. So if I sell them for 455 right now, I would leave a good till cancel order to buy them back at like 225, maybe 220 if I'm feeling a little, or two even if I'm feeling a little salty. Like if I think I could squeeze a little bit of more juice out of this thing. But yeah, I think the 150s in October, I would sell them and use 150 as my stop. If we break 150, I'm getting out. And guys, if you're selling naked puts, this is obvious to some of you, but others it's not. If you sell a naked put, that means you're on the hook to buy the stock if the stock craters, if the stock crashes. If we're selling the October 150 puts and sometime next week, Pepsi has some bad news and I think gaps down to 130 or 125 down to the yearly lows, which totally could happen. You're on the hook to buy the stock at 150, no matter how cheap the stock gets. You're on the hook to buy it at 150. So if you're going to do a naked put short selling strategy, you have to be vigilant about your risk management. You have to have a good, obvious support level that you think can stick. And worst case scenario, you got to be willing to take on the stock. You need to have enough buying power in your account to take on the stock. If you don't have enough buying power, you will still be assigned the stock, and your brokerage will issue a margin call. Nobody wants a margin call. That's just a headache that you don't want to deal with. But I like it. I like this trade. Just keep in mind, and this is a rule of thumb I use every time when I sell naked puts. And I don't sell naked puts a whole lot, but I do occasionally when there's a tactical opportunity to do so. Size your position in a way. This is how I do it. Okay, I'm not telling you how to do it. I'm just telling you how I do it. I will size my naked short put position in such a way that if I were to get assigned stock, right? If the stock crashes, if I were to get assigned stock, the dollar value of that stock position would be worth no more than approximately 10% of my account. So think about that. If I bought 100 shares of Pepsi at 150 bucks, okay, I got assigned on these puts, right? That would be $15,000, right? I want that $15,000 to be no more than 10% of my account. So that means I have to have a $150,000 account, right? A minimum. If I have a $150,000 account, then great. If I get assigned 100 shares of Pepsi, it costs me 15 grand. That's 10% of my account. Now, why is that important? Because in the very unlikely scenario that Pepsi goes to zero while you're still holding this stock, right? Well, if the stock goes to zero, the 15 grand that you paid, which hopefully is less than 10% of your account, that's a loss. That means you lost 10% of the value of your account. Now, losing 10% of your account sucks. Nobody wants to lose 10% of the value of their account. But a 10% loss is a loss you can come back from. A 10% loss of your account does not kick you out of the game. It does not bankrupt you. You still have plenty of chips in the till to keep playing. All right. So do it conservatively. If you're going to sell naked puts, do it conservatively. Do it in a way that you can't be taken out of the game, because that's the one thing we traders have to guard against more than anything else, is having a trade or a series of trades that can take us out of the game. Because if we lose all our money, we certainly can't win it back. All right. So that's my lesson to you guys. All right. It seems like we've run out of questions here. We don't seem to have any more questions coming in. And we've run a little bit over a half an hour now. So my promise to you guys is I'll keep the office hours open for 30 minutes at least. We can go longer if we need. But it seems like you guys are good. So, hey, we'll be doing this again next week. We may have to switch the time. I've got an ongoing commitment on Tuesdays that I need to make space for. So we may not be continuing the show at this time or this day. We may even move it to Mondays, to be determined. I got to talk with the team and see what the TV schedule here is at Stock Market TV. But we'll definitely be back next week doing this, and happy to answer your questions then and share whatever insights I've got. So have a great trading week. Summer trading is over. It's time to get down to the business. It's time to get serious. We're going to have a stretch run into the end of the year. I think we're in for some fireworks. We might even be in for a big bull market rally. That's my feeling. I could be wrong. I've been wrong before. I'll be wrong again. But we should be ready. I hope you guys are rested, because it's going to be a ride. All right, everybody. I'll see you next time. I'll see you on Thursday at the Options Jam session for All-Star Options members. I mean, anyone can watch it. But it's a show where we review open positions in the All-Star Options portfolio, any exits we may have had over the past week, any new positions we've put on. We'll talk about those, and we also review updated stops on positions that we have that are working and going our way. All that stuff is done in the Options Jam session on Thursdays. So tune in then. I'll see you then. I'll see you on the morning show on Thursday as well. All right, everybody, have a great week. I'll talk to you again soon. Bye-bye.